I'm joined by Yogesh Dewan, CEO and founding partner of Hassium Asset Management. Yogi, first of all, I just wanted to, we had this breaking news this morning about the banks, and it seems that we may have entered a second phase, that the rating agencies now are not just looking at different countries in Europe, but are saying, well, hold on, this banking system doesn't seem right to me. Is this a concern when you're asset allocating?
Absolutely. If you look at what's happening in the financial markets and financials and banks in general, they all sold off yesterday. They've been under continued pressure. Everyone is very concerned about their exposure to sovereign debt, especially the US banks. They're also concerned about exposure to European banks and what is actually going on. Investors would be wise to steer clear of the sector in this environment at the moment.
Given the sell-off of the past few days, are equities really the place to be still?
We think they are. Yes, equity markets have sold off. We've actually been very cautious for quite some time, but we have been reallocating when markets have reacted to events geopolitical in nature. Our view is that valuations are still very attractive. If you look at estimated price-to-earnings ratios in the US, they're at 12. If you look at Germany, 11. UK, France, around 10. Valuations look reasonable. The other thing is we have a very low interest rate environment as well, and that's supportive to the global markets improving.
But when you talk about reallocating, is it actually reallocating money that you had, for example, in bonds into equities, or is it money in equities that you move around for the ones that look the safest, so Europe as opposed to the US?
Sure. Over the last 2 years, we've been running an equity exposure of in the order of 10 to 15%. Post-Japan, post the US being put on negative watch, we actually started to increase our allocation to global equities. Bonds just looked expensive. They still offer carryover cash. Commodities, well, we saw a huge rally in commodities and now a pullback as well. We actually took our gold off the table last week. We took our silver off the table last week. We took our oil off the table as well last week.
And as far as the bond market is concerned, a lot of talk about inflation, higher interest rates. You think that's already priced in?
Absolutely. If you look at what's going on in interest rate futures, way too much is already priced in. We've got 3 rate hikes priced in Europe. We've got 2 in the US, 2 in the UK and 1 in the US.
Which we may not get, actually. They're priced in, but we don't know yet, do we?
Absolutely agreed. We don't think it will happen. We just don't think the rate hikes will actually take place. But the thing is, you always need exposure to bonds. They do offer carryover cash. Interest rates are extremely low. Investors do allocate to bonds.
But why not look into emerging market bonds that seem that little bit safer?
They don't seem safer to us. I mean, valuations are a lot more stretched. There's a lot more political uncertainty. Inflation is much higher in emerging economies. Our view is if you want to take risk by increasing your exposure to global equities, not to play around in the bond market.
What about commodities, base metals? You seeing opportunities there?
Yeah, absolutely. Base metals sold off. Agricultural commodities actually sold off as well. We actually like those asset classes more than gold, silver and oil.
Gold's at the top, you reckon?
Gold is in bubble territory. It really makes no sense to be at these sorts of levels. If you look at gold back in the 1990s, it was $400 a troy ounce. It hit a low in 2001 of $253 a troy ounce. Gold at $1,500 a troy ounce.
And yet people say it'll go to 1,800.
As soon as interest rates start to increase, investors will reallocate to riskier assets. They will sell gold, they will sell silver, they'll sell the Swiss franc, and they'll reallocate to global equities.
Just very quickly, how concerned are you that rating agencies are again at the forefront? They've missed the financial crisis, and now it seems that investors are really taking their cue when, for example, they downgrade banks. We're expecting a sell-off in banking stocks today. Is that a concern?
It is a concern, but I do think the rating agencies are too slow to respond. We've had a whole range of reactions with sovereign debt. We now have the banking sector. It's too little too late, to be totally honest. Investors are already aware of the problems.
Thank you very much indeed.
Pleasure
Exciting
as always.
times.